piercing pattern. So we know we have a potential support area based on the piercing pattern. And although we don't know it's a hammer until the end of the day, if the market gets near that low of the piercing pattern intraday and then starts pulling up, you may be buying it then, okay, because it's confirming a support area. But if you're just looking only, if say you work during the day and you come back at the end of the day and you have the hammer, you wouldn't have done any trade because it didn't pull back to the hammer for us to buy it again. You missed. That's right. Yeah. Right. Yes, you could buy it with the resistance areas broken, and what I would do is classic Western technicals when we're in a lateral trading range, a box range, the Japanese call it, is you take whichever way the market breaks out, you take the height of the range. So here it broke out to the upside, and this is 172.40, a little hard to see. Yeah, 176, so what, about 350 pips? Am I doing that right? So at 350 to 176, my target would be 179.50. Keep in mind, a target doesn't mean that is necessarily where it's going to stop. It's a minimum target. It could get above that. And also, if you're trading with price patterns, and we'll look at price patterns in a couple of minutes for targets, it doesn't mean you let the whole position ride until you get to your target. Nothing wrong with taking profits along the way. Okay, here we have a bullish engulfing pattern, also a hammer. And risk-reward, I don't know, it might be 2 to 1. I have to look at the numbers, but it doesn't matter about the numbers here. The idea is I want you to get very used to always thinking about this concept, about if you're placing a trade, where's the stop and where's the potential target. Okay, here we have a morning star, light green. By the way, the arrows here, this is actually, we're in a beta test now of the scanning software, and on the top there, the arrow says morning star. So what I did was I said, okay, find the morning stars in the, I don't know what this is, this might be euro, in the dollar yen. And it highlights it. So you have the green, the green rectangle may be a little hard to see there, but it just picks out the morning star based on my definition. So the trend was down. Okay, it looks lateral, but the trend was actually down based on how I define trend, and that is proprietary for the software. Now, just because you know it's a morning star, that's only part of the challenge. Now you have the candlestick signal. What do you do with it? Do you buy with it? The answer in this case is no, because of the poor risk-reward. So just because if you use a scanning software or you do it on your own, you have a candlestick signal, use that as your first step. The second step is analyze if the risk-reward is attractive. In this case, it wouldn't have been. Yes? Yes. Yeah. He's saying, just to be clear, isn't that followed by an evening star? And the answer is yes. Exactly. Now, if you view that as an evening star, which I would, why would you not sell short on that evening star? It's still at a support level, right? I'd wait for it to close under the evening star, and as soon as it closed, actually, it closed under the morning star. As soon as it closed under the morning star, that to me was quite negative, because not only did it close under the morning star, wasn't that morning star confirming a support level? Right? So I would be perfectly comfortable being short there. That's a momentum play, right? We have the morning star. At least that keeps us in from going in from the short side. Where do we go short if we see a morning star? Let it break the support area of the morning star. Okay, let's think about this risk reward. Okay, what do you think? How many like it?
Excellent.
Yeah, I think it looks great. Yep. I think it looks really good. The hammer support and resistance, I would say, once again, a little hard to see, this is the dollar Canadian, around 125. One of the things we'll look at later is prior support can become resistance. So we may have had a support area over here. So that would be my first potential resistance. I would call this R1. But the much more important resistance would be up here at R2, at that second red line. But even if you view R1 as a conservative, what I'll do sometimes is have a conservative and a more liberal target. even if you viewed R1 as a conservative target, I think this risk reward looks fine. And if your question, then go ahead.
You won't enter at that hammer, right? Because all the next candles, some of them goes below the hammer.
Okay, none of the candle signals after the hammer closed under the hammer. They moved under the hammer, but they didn't close under it. I don't think so. I don't think any can.
To the right.
Oh, yeah, I see.
Okay. It didn't close under the hammer. It moved under it, but it didn't close under the hammer. And in fact, if you were a little bit more nervous about buying in the hammer, which is perfectly fine because although it's a hammer, isn't a new low close for the move on that hammer? Isn't that a new low close for that move? Right? So we'd say to ourselves, okay, maybe we'll buy on the hammer, but nothing says we have to be fully in the position. 25, 50%. And then as the market is building a base there, we could add to the position. I like it when the market expands on the base. Okay, the Japanese say ice 3 feet deep doesn't form in one day. And something like this is absolutely great because you're expanding on the base. And when that happens, once the market goes, it could really get going. And what's nice also about expanding on the base, you have a very important support area. So for momentum players, if we're expanding on the base here and the market closes under the hammer's low, that's the time to go short. For those who are playing the candles as reversals, as long as the hammer holds the support and expanding on the base there, I'd be adding to long positions. Okay, the if-then system. We're spelling out discipline. Again, it may not be in order. The first two we happen to be DI, but we're doing that, but they're not all going to be in order. If-then. That means if the market does such and such, then we react accordingly, if-then. So if the market breaks support, then we think about selling short, like the prior slide, right? If the market breaks resistance, then we could think about going long. If the market stalls at resistance, then we could think about selling short. One of the major mistakes many traders do is anticipate. So let's say we have a very important support area, and the market is holding support, but there's no bullish candlestick signals yet. Some people may say, hey, I'm going to be buying on the support, thinking it's going to hold, but we really have no confirmation. And very often in that case, if there's no turning signals with the candles, the markets will break support. Once again, it becomes a trade-off between profit potential and risk. Let's say the market, let's do it the other side. Let's say the market's moving up and it's getting to a resistance area, and you're thinking it's going to break through the resistance area. You don't know until it's done that it's going to break through resistance. The market's at resistance, no signs yet of either, let's say bearish candlestick signals. The market's let me backstep here. Let's say the market's at getting to a resistance area. It's moving up. Now, do we know if it's going to break support or, in this case, resistance? Do we know the market's going to break resistance? No. Let's say you feel it's going to break resistance. So you're going long before it breaks the resistance area. If you're right, you have more profit potential, correct? But what about the odds of the trade working? Less, because the market has not yet broken the resistance. If we wait for the market to break resistance, the odds of the trade working are much higher. We do have less profit potential. I prefer the latter scenario. I'd rather have the market break resistance